Hi, this is CH. This video is part of a series of videos titled My ABCs, or Absolutely Biased Comments, to share how an individual investor like you and I can try to find out more about an investment fund from public sources and do some basic research or simple due diligence before deciding to buy the fund or walk away. Do explore the other funds covered in this series and subscribe to the channel if you find this video useful. Some quick disclaimers before we start. This is not a product sales pitch or a recommendation to buy. I'm not sponsored by anyone to do this video. Please do your own research and be clear about the product features and risks before taking any action. The information shown and mentioned in this video is accurate as of the date stated here. In this video, I will be talking about the SICAV version of the Franklin Income Fund. This video is done as a follow-up request from a viewer's comment in my previous video covering the FTGF Clearbridge Infrastructure Funds. If you would like me to cover any funds or ETFs, do drop me a comment in any of my videos and I'll be happy to work on it as long as I can find enough information on the product. The reason why I'm stating this is a SICAV version is because Franklin Templeton is using the same fund name for a similar product meant for US investors. What this video is covering is the one for non-US investors instead. This is also more consistent with Franklin Templeton's branding, as they have indicated the same in their website that features the fund with its 25th year since inception. That being said, you should not need to include the word SICAV when searching for the fund in your distributor's websites or fund lists. Since we are talking about SICAV, let's start off with the fund structure. The Franklin Income Fund is a sub-fund under the Franklin Templeton Investment Funds, or FTIF in short, fund family. FTIF is set up as a Luxembourg SICAV company structure and is UCITS qualified. Singapore-wise, the fund is registered as a MAS recognized scheme, which means it is suitable for retail investors. The company started off as Franklin Distributors Incorporated, a US investment firm focusing on providing mutual fund solutions. It was founded in 1947 by Rupert Johnson, who named his company after Benjamin Franklin, one of the founding fathers of the United States. In 1992, Franklin acquired Templeton, Graybrooke and Hansberger Limited. The latter was owned by Sir John Templeton, who, among other accomplishments, is famous in the funds industry as a pioneer in emerging markets investing. The resulting company is rebranded as Franklin Templeton, as it is known today, with Benjamin Franklin's portrait as part of its company logo. Today, Franklin Templeton is a multinational investment management holding company. In the US, its business branding is Franklin Resources. Elsewhere, besides its own Franklin Templeton branded products, it hosts a long list of boutique fund management brands that it has acquired over the years. This has led to Franklin Templeton becoming one of the top global fund providers today, managing about $1.5 trillion of assets via 1,600 investment professionals located globally. While Franklin Templeton publicly listed its US business Franklin Resources in 1971, the company has through the years retained control and leadership within the Johnson family. Rupert's son, Charlie, took over as president and CEO in 1957. Charlie passed the baton to his son Greg in 2005, who became the CEO. In 2020, Greg's younger sister, Jenny, took over as president and CEO. The Franklin Income Fund falls under an investment team called Franklin Income Investors, who focus on providing multi-asset income solutions since 1948. The team manages about $92 billion of assets and is based in California, US. The Franklin Income Investors team currently comprises of 3 managers: Edward Perks, Brandon Circle, and Todd Brighton. These 3 are also the co-managers of the Franklin Income Fund. They are supported by research teams from the Franklin Equity Group and Franklin Templeton Fixed Income Group. Edward is the lead portfolio manager and has been managing this fund since 2002. He is the CIO of the team and also sits on the executive committee of the firm. Edward joined Franklin Templeton in 1992 and is experienced in various asset classes and industries. Todd started co-managing the fund since 2017. His experience tilts more towards equity investments and volatility-based strategies. Brandon started co-managing the fund since 2019. His experience appears to be more focused on investment grade and high yield credits. Morningstar shows there had been some movements in the fund managers in the past, though it seems to have stabilized now, and the important thing is Edward has been with the fund for over 20 years. It is also good to see Franklin Templeton provide these manager details in his website. The fund objective, as per stated in the fund webpage and fact sheet, is a short paragraph that states the primary goal of the fund is to maximize income, and capital appreciation is not a necessity. It also states the fund invests in both equities and bonds, which we already know after understanding the nature of the team that manages the fund. But what is not clearly stated is that this fund is actually a US market-focused strategy. If we look at the benchmark, we can see it is a customized benchmark comprising of 3 US indices. There is, however, a link blended stated. So what in the world does that mean? It turns out from the footnotes that this simply means there was a change in benchmark in January 2019. Prior to that, it was 50% S&P 500 index plus 50% Bloomberg US Aggregate Index. Post of that, it was changed to 50% MSCI USA High Dividend Yield Index plus 25% Bloomberg High Yield Very Liquid Index plus 25% Bloomberg US Aggregate Index. From the benchmark information, we can gather some important information. Firstly, the intended portfolio mix of the fund looks to be around 50% US equities plus 50% US bonds. Given it is more common to see a 60-40 equity to bond allocation, this mix looks to be slightly more risk conservative. Understanding this also allows us to make more meaningful assessments when comparing with other funds. Secondly, changing the equity component of the benchmark from S&P 500 to MSCI USA High Dividend Yield is essentially shifting the fund strategy from a more core to growth bias exposure via S&P 500 to a more value-focused exposure. Thirdly, adjusting the bond component of the benchmark by specifying 25% US high yield tilts the fund strategy to take on more risk in the high yield bond space in exchange for better returns or yield. Coming back to the investment objective of the fund, it now makes better sense that the paragraph also states the fund may invest up to 25% outside of US. However, the fund documents do not provide any details on non-US exposures in the actual portfolio. The Fund Product Highlight Sheet or PHS provides similar contents for the fund strategy but included a puzzling bullet point where it states the fund will invest in utilities, energy, real estate, and consumer goods sectors for growth opportunities. Now, the Franklin Templeton sales team better review this because these are value-biased sectors that are unlikely to give much growth. The fund prospectus fortunately provides a lot more details on the fund strategy. Here, it elaborates a bit more on the types of equities and bonds the fund can invest in. For example, preferred stocks, convertibles, and equity-linked notes. This is important when we look at the fund portfolio later. There is also a long paragraph talking about credit rating, but we already know from the benchmark construct that the fund will likely have about 25% exposure in high-yield bonds. It also explains the allowance for up to 25% of non-US securities mainly refers to non-US stocks that are traded in the US as American Depository Receipts or ADRs. The next paragraph provides a bit more details on the selection criteria in the investment strategy. It is stated the team searches for undervalued or out-of-favor securities it believes offer opportunities for income today and significant growth tomorrow. Linking to the fund's objective, I would interpret this as the fund looks to invest in equities and bonds that are currently undervalued but with growth potential, and that they provide sufficient current income to fulfill the fund's income requirements. There are some bullet points giving further examples of selection criteria, although they are still worded quite vaguely. The section then talks about the usage of derivatives, which goes beyond the usual portfolio hedging and management. This fund will use derivatives for investment purposes, which includes various structured products and options, and also to gain exposure beyond equities and bonds, for example into commodities. Investors who have limited knowledge on derivatives and structured products should take note and consider whether such a fund is suitable for you. The next paragraph is interesting. It states the fund may take a temporary defensive position during market stress, and therefore may not pursue its investment objective when that happens. Now this is again quite vague, as it doesn't elaborate whether the fund will reduce risk positions and hold cash, or use derivatives to hedge volatility, or do something else. Additionally, navigating through market stress should be part of the fund's investment journey, and considered within long-term objectives. So I'm not sure why it has to be stated here that the fund may be unable to pursue its investment objective. The next paragraph is a common disclosure for income-focused funds, where it states the distribution income can be extracted from capital and translates to a reduction in NAV. We will see later if this fund is one of those that sets a high distribution payout but suffers substantially in NAV. Investors should always bear in mind that fund investing is like stock investing. Every dividend payout means there is less capital remaining to grow the investment. Finally, the prospectus states the limits on total return swaps and leveraging used in the portfolio, as well as the expected levels. From these descriptions, it seems the fund will not be utilizing them much. While the US version of the Franklin Income Fund was incepted in 1948, making it probably the oldest multi-asset income strategy in the market, the SICAV version that we are covering in this video is incepted in 1999. Still, that makes it one of the earliest multi-asset income strategy outside of US markets. The fund AUM is currently over $8 billion US, which is a decent size for its strategy. The fund webpage and factsheet provide sector allocation breakdown on both equity and bonds exposures in the portfolio. Here, we can see that technology sector, interestingly, is the top equity exposure, even though this is meant to be a value and income-focused strategy. The subsequent sectors of healthcare, energy, and consumer staples look more normal of what to expect of this fund. Bonds-wise, allocation looks quite close to the benchmark, with about 24% in high yield, 15% in investment-grade corporates, and 12% in US government-related bonds. But what is important is the overall asset allocation breakdown, where it shows about half the equity exposure is in convertibles and equity-linked notes. The fund webpage allows for downloading of the full 400 plus holdings, and we can see easily from there that the portfolio has a ton of equity-linked notes. The usage of equity-linked notes in mutual funds is less common these days, as more managers seem to prefer using covered call options instead. So for those of you who are not familiar with these derivatives or structured products, let's do a quick 101. Equity-linked notes is a structured product, normally comprised of a zero coupon bond and a buy call option on the stock. You don't need to own the stock, though you will need to have the capital to buy the equity-linked note upfront. While there can be many variations to the structure, the common approach is to have a 100% capital protected structure, which means you won't lose money if the stock price goes down. On the other hand, if the stock price goes up, you gain profit by participating on the up movement of the price until a cap limit. So this is an approach to try to make small gains on the stock that you expect its price to go up without taking downside risk. Covered call options is to sell a call option on a stock that you own. By selling an option, you make a small profit on day one. You do retain the full downside of the stock if its price goes down. On the other hand, if the option strikes at the predefined level, you do need to sell the stock, meaning you also have a cap upside. This is an approach to try to make small gains on a stock that you expect its price to stay flat or goes up slightly. Let's quickly go through some hypothetical examples. Assuming you spend $100 to invest in an equity-linked note on XYZ stock with a 5% cap for 1 year. Within that year, XYZ pays out a $1 dividend. But since you don't own the stock, you don't get that dividend. At the end of the year, XYZ price goes down 10%. If your equity-linked note is 100% capital protected, you get back $100. If, however, XYZ price goes up 4% to $104, and your equity-linked note participation rate is 100%, you will get back $104. If, however, XYZ price goes up 20% to $120, you will get back only $105, given the 5% cap. For the other approach, you spend $100 to buy XYZ stock. You then sell a covered call option with a strike at $105 for 1 year and make a $1 profit out of it. Within that year, XYZ pays out a $1 dividend, Since you own the stock, you receive that dividend. At the end of the year, XYZ price goes down 10%. The option expires and your holding in XYZ becomes $90. If, however, XYZ price goes up 4% to $104, the option doesn't strike and expires. Your holding in XYZ becomes $104. If, however, XYZ price goes up 20% to $120, the option strikes and you are obliged to sell your holding in XYZ at $105. The reason why I'm spending some time to explain this is because derivatives and structured products are complex investments. Many retail investors do not have enough knowledge to understand the risks and features. Therefore, it is important to take extra caution when investing in mutual funds that actively utilize them. Also, there are different pros and cons comparing equity-linked notes versus covered call options. Both are commonly used for the purpose of income generation in mutual funds, but the investment approach behind them are very different. So hopefully these few minutes of 101 help you understand them better. So coming back to the fund portfolio again, this explains why there are so much technology sector exposure in an income-focused fund. You need more growth stock with fast price movements for equity-linked notes to work. I am, however, not a fan of this investment approach, as I would rather rely on traditional means of natural equity dividends and bond coupons to generate income. Lastly, the fund webpage also provides some portfolio statistics, though these are generally hard to be used for comparisons, as every multi-asset fund has different strategies and exposures. Share classes of the Franklin Income Fund is quite straightforward. The normal retail share class is A class. The fund is base currency in US dollars and offers Sing dollars, Euro, Aussie, and Japanese yen hedged share classes. There are other currency share classes such as Sterling Pound and Renminbi available, though they are not registered in Singapore. Besides US dollar class, which has an accumulation version, all currency share classes offer monthly distributions. The oldest share class here is the A monthly distributing US dollar class incepted in 1999, followed by the Sing dollar hedge class in 2007. The rest are relatively newer. The retail A share class has a 1.35% management fee. Adding other expenses gives around 1.66% to 1.67% total expense ratio or TER. This looks to be slightly lower than most other multi-asset funds in the market. Up to 47.5% of the management fee may be paid by Franklin Templeton to distributors as trailer fees. The fund allows up to 5% subscription fees to be charged by distributors, although I think anything more than 2% for mutual funds is excessive. Distribution information of the fund is found in a separate document that consolidates the data for all sub-funds under the fund family, but only for US dollar and Sing dollar share classes. For the others, I have to go to the Luxembourg website to obtain the yield data. Franklin Templeton provides quite a lot of details on distribution, which is good for investors. Using the A US dollar share class as an example, we can see the share class has a smoother distribution payout policy. That means the dollar value of the monthly distributions stays stable. This translates to a distribution payout yield of around 8.6%, which is significantly higher compared to the portfolio's yield to maturity for the bond allocation, or average dividend yield for the equity allocation, or the overall underlying portfolio yield. That clearly means some of the distributions must have been paid out of capital, which is also clearly stated in the document. We can also see here that the current distribution payout yield is significantly higher than the average payout yield of the fund since inception, which makes me wonder how sustainable is this high payout yield and what is being sacrificed for this? By retrieving the data from the fund web pages, we can see the distribution yields have been maintained deliberately at around the same levels across different currency share classes. This means the currency hedging costs are being attributed into the NAV. We will see how this impacts the overall performance experience shortly. Franklin Templeton's product web pages contain quite comprehensive information for investors. As seen, we can easily obtain Franklin Income Fund's performance data for past 10 calendar years and also annualized returns across periods. Starting off with calendar years, the fund has outperformed the benchmark only 4 out of past 10 calendar years. On annualized periods, the fund has outperformed the benchmark only for the 5-year period. So far, this looks pretty disappointing. So while the fund made changes to its benchmark in 2019, it seems that it did not benefit the fund in terms of relative performance to benchmark. There are also some risk measurements available that only serve to further highlight the fund is performing weaker than the benchmark, with generally a slightly higher standard deviation but negative information ratio, which means the fund is taking more risk than the benchmark but still generates lower returns. Also, looking at the annualized performance again, we also need to remind ourselves that the fund is currently paying an 8.58% distribution yield, which looks significantly higher than the annualized returns across all time periods. Therefore, the only way to make this happen is that the fund's NAV has to go down, as capital is used to top up to this distribution yield. Franklin Templeton very nicely provides NAV history chart as evidence to this. I don't know when the distribution yield was set to such a high level, but the fund's NAV peaked in mid-2014 and has been on a declining trend since then, dropping about 30% through this time. Now, I personally dislike such investments where capital is sacrificed for income. I would rather the fund pay out a lower but more sustainable distribution yield instead, and at least keep the NAV flat or growing slowly over time. For the Sing Dollar share class, this problem is even more glaring, as there is also currency hedging costs factored into the NAV. As such, we can see the Sing Dollar share class was incepted at $10 NAV in 2007 and has dropped to $6.22 NAV today. So is the Franklin Income Fund a poor choice even within peers? For US multi-asset income strategies, I think another fund that is popular in the retail space is the Allianz Income and Growth Fund that can be used for comparisons. The strategies of the two funds are different though. Franklin Income Fund, as we have gone through so far, has a 50% equities, 50% bonds allocation. About half of the equities are equity-linked notes, while the other half are direct stocks. About half of the bonds are investment-grade government and corporate bonds, while the other half are high-yield bonds. Allianz Income and Growth Fund adopts a 33% equities, 33% convertible bonds, and 33% high-yield bonds allocation. It typically deploys covered call options on a substantial portion of the equity positions. From this, it is not easy to tell which strategy has a higher risk profile. So let's take a look at the performances. Here is a 10-year chart from Morningstar comparing the two funds, where we can see Allianz has delivered about double the returns than Franklin during this time. This 5-year chart shows Allianz tends to have a higher volatility than Franklin, but leads to an eventual better return. This goes to show that the Franklin Income Fund has a rather low risk portfolio. The first reason is that Franklin has a 25% allocation to investment-grade bonds that is naturally more defensive. Allianz has none of this and takes on a higher 33% high-yield bond exposure. The second and more important reason is that Franklin has 50% equities, but these are 25% in mostly value, low-growth stocks, and 25% in equity-linked notes with upside cap. Allianz has only 33% equities and uses covered call options, but it tends to have higher exposures to growth stocks that can generate better capital appreciation. So I think Allianz has gotten a better investment strategy in terms of delivering performance. Another way to see the poor performance of the fund is that it has barely outperformed the PIMCO GIS Income Fund, which is a pure bond fund, over a 10-year period. In fact, you will be better off performance-wise if you deploy your monies 50% into PIMCO GIS Income Fund and 50% into Amundi Prime USA Fund as examples, and manually do partial redemptions for your ad hoc income needs. The same can be done if you are a Sing Dollar investor, using the Sing Dollar share classes of the same funds. With that, let's summarize our findings. Franklin Templeton is one of the leading global fund providers with a long heritage. Product offerings are broad and its branding is well known in the retail space. The Franklin Income Strategy is one of the earliest US multi-asset income strategy in the market, having incepted in the US in 1948 and launched the offshore SICAV version in 1999. The strategy is managed by a dedicated small investment team within the firm. The fund webpage and documents provide enough details to clearly explain the 50 equities plus 50 bonds allocation strategy. However, on the overall, it looks too defensive and doesn't seem to generate enough returns. Additionally, the benchmark changed in 2019 that tilted equity exposure towards more defensive high dividend style and bond exposure towards more aggressive high yield positioning is puzzling. It might have been easier to retain the original benchmark and make active adjustments to the portfolio according to market conditions. Having about 25% exposure in equity-linked notes is questionable. While this provides a low-risk approach to generate some returns, the upside is capped, and so participation in bull markets is significantly constrained. High distribution yield at above 8% levels looks unsustainable for the fund, which has shown to be able to deliver only about 5% per annum total returns since inception. The progressive decline in NAV will ultimately upset investors. The total returns of the fund is too low when comparing against other US multi-asset income peers and even with decent performing bond funds. The fund strategy needs to be more aggressive to generate more competitive performance to make better sense to investors. In conclusion, the low performance generated by this fund is the killer that makes it unattractive. There are better choices for investors out there as we went through earlier. This concludes my absolutely biased comments on the Franklin Income Fund. Again, if you find this video useful and would like to see more related contents, please subscribe to the channel. Thank you and have a great day.